right, so it's 7 o'clock. Um, Different time for the Collaborate session. I see a couple of people are out there. Can anybody I want to make sure you can hear me before I go off and talk to myself for another 45 minutes? Again, the YouTube thing worked, but if you can, just go ahead and text and let me know things are going well. Well, not exactly a vote of confidence. Okay, not hearing anybody out there. We will proceed on. Um, we'll see. This whole thing is fluid in terms of when, um, when we meet or whether you even want to do the collaborate thing. It's some parts of it are fairly useful. For example, people send me an email about the exam, about the midterm. How that's going to work, and maybe I didn't explain it very well in the syllabus. But what I'll do is it'll be done via Blackboard, and it'll be open for about a week during the period of the midterm week. It's automated and all that, so if you go to look up your answers on Google or something like that, generally it'll shut down the program, and then you'll have to send me an email and say, yeah, I closed the program, and can you please zero out that score and let me reaccomplish it. So if you mess with it too much, it randomizes questions, it does all that kind of stuff. So it's pretty good in that regard in terms of keeping people honest. Anyway, what we're going to talk about tonight, if we can get this thing to go, is some of the consumer borrowing type things. But one thing I did want to tap on is when we're talking about the economy, and I'm talking about, the economy's not in that great a shape. You go, wait a minute, unemployment's down. Well, this chart is something you don't see too often, and this shows the what it factors in is the labor participation rate. So if you look at the labor participation rate, with that factored in, you're looking at about 10.8% unemployment. Whereas if you're looking at just the unemployment rate, because there's fewer people out there searching for jobs, I know it sounds counterintuitive, but believe me, that will bring down the labor rate because of the way they calculate the samples. So, there's one other slide here that's worth showing, and again, this isn't to scare anybody, but it is to sort of show what's going on. You can see the growth rates, the participation rates, and the participation rate. The first column. See how those numbers, for folks are going down. Started out at 66.4 back in 92, and now it's down to 61.6, and that was that was forecast for 2022. But it's in decline, so 63.7 for 2012. The other weird thing about this is, although the participation rate's going down for people in the younger age groups, you can see the old folks are still working. So not good. Maybe they're being forced to work, maybe they want to work, or maybe they have to work. So anyway, no judgments there, but just make sure that for the good news for you is, as a college graduate, your unemployment numbers are far less. And if you're go on to get a master's, then you're talking about negligible unemployment. So don't worry too much about that. Did skip that one. Consumer credit's what we're going to talk about here. And I got confirmation I could be heard, so that's good. All right. So objectives, consumer credit, differentiated loans credit. We'll go through all of these as we work through it. What is consumer credit? I don't mean to be the bad guy about credit. Like I say, I generate a tremendous amount of money through my credit cards because I need the miles, and I'm going to spend the money anyway, and it keeps track of it. So not all credit is bad. In fact, credit that's used for making money, using other people's money to make money is a good thing. And that can be true in business, but also can be true in your house. Leveraging is a powerful concept when we talk about housing, and that's using basically the bank's money. Let's say the housing market goes up by 2% a year, not a huge amount, and I'm just pulling those numbers right out. I'm not making any statements what the market's going up, but my statement would be, let's say for some reason you're able to control $300,000 with uh, $30,000 worth of your own cash in there. Well, 2% of 300,000, that's a fair amount of money, you know. So you're making, and what are you using? You're controlling 30,000, or with $30,000, you're controlling 300,000. So, you know, um, the 2%, you know, that's 6 grand. 6 grand on $30,000, $6,000 return on $30,000. That's a hefty percentage. So it's a two-edged sword. You know, if you're in a speculative market and real estate goes down, you can get burned just as easily. But I know a lot of folks are risk averse, and a lot of folks, you know, regardless of how I, you know, pump up the stock market, it's you know, it's not for everybody. But a house, you can invest in it, you can live in it, and the rest of it. So anyway, we're off on a tangent there, but not all credit's bad. Consumer credit, that specifically excludes a home mortgage, and usually, you know, not a great thing. But what consumer credit can help you do is avoid having stacks of idle cash around and still feel comfortable that you can meet problems. So, you know, way people finance purchases, draw on their savings, present savings, borrow against their special future income. Anyway, there's always trade-offs. And so consumer credit, you know, the marketing's out there. They're always going to push for you, and it's up to you to know when to say yes and more than likely when to say no. Misuses, yeah, this is where, you know, anyway, salesmen can talk you into things. You know, you can, anyway, I'm not going to preach to you about, you know, if you haven't got involved with credit cards and overspent before and had that feeling, then, you know, that's something life experience will have to teach you. But hopefully it'll be a quick lesson. You'll get right through it and realize that was not the way to go. So obviously, yeah, can you postpone it? What are the opportunity costs? What are the dollar and psychological costs? Credit purchases. But a lot of times there's alternatives. You know, if you shop around, if you get, you know, last year's model rather than this year's model or whatever, you know, there's certain quality of life things, and especially like a vehicle here in the winter, you don't want to necessarily have a beater when, you know, you're hauling your kids and stuff like that around, and I get that. But then again, you know, most people are well beyond beaters and into something that's just a huge depreciating pile of steel. So, anyway, not to preach again. Whoops. Okay, I do not like the way this thing advances slides, but we'll get through it. So, misuses, we talked about that. Looking at the notes real quick. Advantages, yeah, permits purchases, cushion for financial emergencies, easy to return merchandise, convenient when shopping. You know, a lot of times the only way you can get the super deals, I mean, anybody who goes into like Kohl's and isn't using their credit card, I mean, you're paying a premium because all their stuff is kind of overpriced unless you have the credit cards, and that's just kind of the way the game's played with them and a lot of other stores. So, but my, you know, advice in terms of smart personal finance is the aspect of being able to use it for financial emergencies by not having to keep, you know, thousands and thousands of dollars in some savings or checking account just in case something bad happens. Perhaps you can have that in a more, you know, aggressive investment or just an investment in general that you can get at, you know, within, say, a month or so. So you put the thing on the credit card and then you know, take that money out of that money market account or sell that stock that you didn't want to. But anyway, you work that out so that you can get that credit card paid off. More advantages, credit card, 1 monthly payment. A lot of times, yeah, go to a rental car place and not have a credit card, and, you know, you'll be treated, they'll want a cash deposit. It just gets more expensive for you. The fraud and the credit thing, yeah, by law, there's better rules with credit cards, and debit cards are kind of you're at the mercy of the bank, the institution who made it for you. Also, if you take advantage of the you know, the float time, the grace period there, you can actually, you know, kind of get one over on the banks by using their money without actually having to pay any interest. I've hit on the airline miles enough. And yeah, there's certain status, but don't get trapped into that. We could all carry around American Express cards, but when you're having to pay a monthly fee, I'd rather achieve status someplace else. I've got to go on a business trip, and I'll take my American Express card because that's what the corporate card is. But it's kind of a drag half the time because they don't take it. So there you go. Disadvantages: overspend, failure to repay. Doesn't really do anything for your purchasing power, and credit costs money if you don't use it wisely. There's certain times if it's truly the sale of the century, and you can buy something now, at a better price than you would in the future. That's smart, but those are pretty few and far between. Types of credit: you have open-end credit and closed-end credit. So closed-end credit is exactly what it sounds like. It's usually for a specific thing, like you're going to buy a car and you can't take out a loan on that. That car loan is specifically for that vehicle, and when it's paid off, that's the end of that loan. Whereas a credit card, it you use it, you pay back, you use it again, so that's open end. So that's what they're talking about, the difference. Installment versus a kind of a revolving credit. Man, this thing is freaking out. So open-end credit, yep, credit cards, bank cards, incidental credit. Most people have credit cards. 1/3 pay balances in full, so those are the smart people. The other 2/3 are the ones that enable all the perks on the credit cards. Because if it wasn't for these folks paying the huge interest, you wouldn't have the airline miles and all that. They aren't making that much money off you on a normal credit card if you pay it off every month. But where they are making the money are people who run up the balance and can be charged, fairly exorbitant rates. There's a reason. If you look at your bank statement, you'll see that it's generally South Dakota, sometimes Delaware. But anyway, the fees that the banks charge, you couldn't legally charge those fees in most states, including Alaska. That's considered usury. But not in South Dakota. And South Dakota is the reason they do this because they want the credit card space there. And so, it works out for one or two states who want the credit card business. But, most states prevent those types of interest rates being charged against their citizens, I guess you'd call it. Smart cards, debit cards, yep. Just like writing a check. And the co-branding thing, that's when, say a Gap card or something like that, where there's, Gap Visa, where there's other charges associated, or not charges, but special Kohl's, things like that, where it's not only store card, but also a Visa card. Protecting yourself, it's tough. You can sign them, you can keep them secure and all that, but they're having so many issues now with a point of sale where once you swipe it, now supposedly they've also got thermal type things where you punch the keypad and they can tell from the thermal signature, the order in which the keys were punched. So the only way you can really keep on top of it is look at your statements quite often, and then if something bad does happen, notify the people as quick as possible. Purchases online, again, it's very tough. If you're being solicited online in terms of for sales, it's more difficult if you actually go to the site yourself directly. You've got a bit more security, but there's things like PayPal and other services where you don't actually give a credit card number, especially when you're dealing with strangers. With businesses, utilities, things like that, you can feel fairly comfortable, but again, you have to reference your statements. Travel and entertainment cards, again, American Express, I'm not a huge fan. They charge a bit of a higher fee, and it's this whole prestige thing of using the card, but it's anyway, when I travel, I usually end up having to pull out a Visa or MasterCard to buy fuel or do whatever, and it's just easier to have a card that works everywhere rather than one that works almost everywhere. So and it's not really a true credit card because they're expecting their money at the end of the month, not part of it. They want it all. It's not a true credit card. They do have some credit card products. Some of these companies do, but yeah, I've had, through various companies I've worked for, Diners, which was not accepted by anybody, and there's some of these smaller companies that I just don't see the point with some of them. Store value, gift cards. The problem like this is, number one, if the company goes out of business, you're stuck. Or if you lose the thing, you can't, there's no way generally to get a refund. It's like carrying cash. I've also had the cards go, bad in terms of the magnetic strip, and then trying to establish some sort of credit on that card is impossible. So, not a big fan. I know they often issue those if you don't have your receipt for refund, so it's better than nothing. But it's not the same as cash, and not the same as a credit card. Home equity loans. So the deal with home equity loans, as opposed to pure consumer type loans, is that in order to encourage home ownership and the rest of that, they have continued with the home mortgage deduction. So that is a huge benefit. Credit cards, that interest, that consumer interest you used to pay, used to be tax deductible. And I'm kind of dating myself because it's been probably 10, 15 years probably since that was the case. But a way around that is using a home equity loan and taking advantage of tax deductible interest. Again, I wouldn't suggest it in terms of taking out loans just to buy a new four-wheeler or whatever. You're still probably better off waiting and paying cash or doing something else. But a home equity loan, now we're talking about putting a lien on your home, so that's kind of drastic. Credit capacity and build your credit rating. Trying to build your credit is kind of a difficult thing, and I've heard people of taking out loans just for the purpose of paying it back to build their record. I don't know that I really agree with the logic on that. Usually, just through the course of living, you'll establish some sort of credit, and then once you do, then trying to turn it off is, you get 4, 5, 6 credit card applications some days. So, yeah, it's tough when you're starting out to get a credit card, but once you do, and then it's a matter of the credit card bureaus and your all-important credit score. A lot of things that affect that credit score, and we'll talk more about that, but things like, let's say you go out shopping for a vehicle and you start in the morning. If you go to 3 or 4 dealers and you actually, go through sort of the loan process with them, or at least they look at your credit score will go down through the course of that day. So there's a lot of variables that go into credit score calculation, and going out and having people sort of assess your credit is one of the things that brings it down, because the credit card companies or the credit agencies got to assume that you may be taking loans and diminishing your ability to pay. So debt to income ratio is one of the things they'll look at. So monthly payments, net income. So what you want is credit card payments should not exceed 20% of your net income, and even less. If I understand, sometimes medical emergencies, other emergencies may cause you to exceed that, but in terms of a long-term strategy, you want to be one of those, basically 1/3 of the population that pays off their bill every month. So again, credit capacity, debt to equity ratio. Look at your liabilities divided by your net worth. Obviously, you want your net worth to be more than your liabilities. So there you go. Co-signing a loan. In general, all I'm going to say about this is don't do it. The reason why I would say that is, if you co-sign a loan, what's going to happen is you are basically, the person who needs you to co-sign, they couldn't get the loan on their own. So they're coming to you looking for some help. And put yourself in the creditor or the debt collector type people.
if this loan defaults, which this person couldn't get a loan, so there's probably a likelihood of them also getting in trouble again. And if they can't pay off the loan, is the debt collection agency going to mess with that person who's kind of had flaky credit? You as a co-signer are just as liable for that debt, so they're probably going to come right after you first. So anyway, if you co-sign a loan, you might as well just take the loan in your name, because that's essentially what you're doing. It's not like this other person is going to be much of a speed bump between you and the collection agency. They're gonna get right to you because they know you've got the cash because you qualified for the loan. Anyway, just keep track of that, especially in terms of bankruptcy and other things. If you do co-sign a loan, yeah, it could happen to your credit rating. That debt is going to be counted against your credit rating until it's finished. The collateral you put up, if you do, could have some trouble there. And then the other thing is too that the initial communication that this loan's starting to get in trouble may not actually come to you. It may actually be in collection with additional fees already added on, and then it gets presented to you. So could be bad. Building and maintaining credit rating. So live within your means, and then keep up on your credit report. You can get a free credit report up to 3 times a year, and then you can also get it anytime you're turned down. And I'm not talking freecreditreport.com and then they have you sign up for some service. There's actually a free credit report that you can get. It doesn't actually have your credit score on there, but it's got all your liabilities and all that, and it costs you nothing. All the commercial sites will try to badmouth that service because they want you to sign up and get some sort of subscription thing. But for most cases, the free credit report's just fine. Credit bureaus, yep, 3 big ones: Experian, TransUnion, Equifax, and they're not popular, folks, because often there's errors, there's other problems, and they've got their tentacles on everything. They get information from any of your behavior that may lend itself to some negative credit reporting. Fair Credit Report Act, it works on the credit reports. They, by law, they have to correct inaccuracies and all these other things. But if you do go bankrupt or you have some bad debts, 7 years or 10 years for a bankruptcy, and then even at 10 years, let's say you're done with bankruptcy, it's 10 years. Now you're not going to have any credit report at all, which is going to be very suspicious. This guy must have had a bankruptcy about 10 years ago. So it's going to take you a long time to dig out from a bankruptcy if you get in that sort of situation. So if you are denied credit, things you can do: write the credit bureau. You can post a comment in there. Anyway, you can do a lot of things, but you got to act fairly quickly. Whoops. Applying for credit, yeah, that's what they're going to look for. You've been flaky before with your bills. Do you have the cash to repay? And then, if you don't have cash in terms of income, if you have a lot of assets, collateral as well, and then the conditions, if it's bad economic times, it's tough to get a loan. Credit is still pretty tight, even though there's a lot of homes on the market and things like that. It's still tough to get a loan. So, how to improve your credit score? So, understanding the system is basically the thing. And again, don't ever pay or sign up for credit reports. They're required to give you free copies. So, once every 12 months, but there's 3 of them. So that's what I'm saying, 3 times a year if you really wanted to get them. But that is something you want to keep track of. Fair Credit Reporting or Billing Act. This is so they can't play quite as many games in terms of when in calculating your balance and calculating the interest. A credit card has certain length of time to respond. They also have certain legal limits in terms of how they're going to calculate interest rates over the period. Withhold payment for dotted or damaged or shoddy goods. If you're pay for them with a credit card. So again, that's a difference between a credit and a debit card. A debit card doesn't have that sort of protection. What if your identity is stolen? So again, it's all about timely action. The best way to do it is once you find out, get those accounts shut down before there's any further damage, and then start going back through and finding out what access they got. They do have these services like LifeLock and some of these subscription things, that are pretty hyper vigilant. I can go through a war story of a savings account that I had that started being billed against it, but I'll wait and see how long we're going to go here, or I may save that to another week. But it's identity theft is pretty serious, and it can be a lot. They don't need that much information. All they really need is your account number. File a police report, privacy rights, file a complaint with the FTC. It's going to be a busy week for you if your identity does get stolen. Complaining about consumer credit, again, there's a lot of laws out there because there are so many complaints. So you need to know what your rights are. Generally, doing things in writing is far better. People tend to take action, especially when it's a written letter as opposed to an email. People tend to delete those things. So anyway, call up with a phone call for timely action and follow it up with a letter is what I do. Protection, you've got all the different laws out there. Just because there's been so much trouble, consumer, nothing upsets you like getting ripped off on some financial scam. So there's a lot of laws out there that will protect you, but you have to know of them and you have to act. Okay, so that was just about consumer credit. Now we're going to jump into Chapter 7, and again, this is very closely related because it's sources of credit, cost of credit alternatives. So credit cards themselves are probably one of the most expensive alternatives outside of pawn shops and title loans and some of these fly-by-night things. But credit card, if you take cash advances on your credit card, that is some very expensive money that you're borrowing. So we'll talk about consumer credit, managing debts, and bankruptcy. So what kind of loan should you take? Obviously, something from the family, assuming everybody's on speaking terms, that's probably the best. Or assets that are loans based on collateralized loans. That means that it's not just a personal loan. There's actually something for the bank or the company to come after in case you flake out. So the interest rate is going to be considerably lower. The finance education from the Department of Education, they do sort of own you at that point, and those loans are not dischargeable under bankruptcy. So keep that in mind. You can declare bankruptcy, but guess what? If you owe money to the government, yeah, they don't mind stiffing the credit card companies, but the federal government themselves will not discharge the loans through bankruptcy. Medium price loans, so commercial banks, savings and loans, you're familiar with this. A lot of times they'll have teaser rates. Just keep in mind that find out what the nature of their promotion is. They aren't working for free here. If it's a car loan, but you have to pay full price for the car, whereas if you brought in your own loan, your own money, you could have got the car for a different price. That's not necessarily a low interest rate if they're doing that. And then these finance, check cashing, some of the retail credit cards, bank cards, again, Visa, MasterCard, and especially on the cash advance side. The cash advance, there is no float period. They start charging you interest right then. Cost of credit, so different ways. The big thing with the laws here, they aren't really going to help you out that much, but what they are going to do is make sure you're kind of comparing apples to apples and oranges to oranges in terms of what you generally want to be looking at is an annualized rate, so that you don't look at a monthly rate of, it's only 2% a month. Well, 2% a month would be, 24% a year. And if they calculate it differently, it could be even higher if they start to compound it. So, what works for compounding in interest when you're earning it is good, but when you're paying it, it's very bad. So anyway, an APR, an annual percentage rate, will allow you to make a true calculation, and that will have to be somewhere on the paperwork because it's required by federal law. When you go to purchase a home, and again, we're not talking home mortgages tonight, but there's several pages in there that are disclosures. Tackling trade-offs, term versus interest costs. So, yeah, there's more exposure to risk, um, in terms of inflation and other things for the retailer when they go out to a longer term. So, variable interest rates, well, you can do that. I've done that on home mortgages before, but man, it's kind of dicey because those things can change, and most people have really steered away from any sort of adjustable variable interest rate. So how do you calculate interest? Interest, principal, rate, time, and then the compounding is what's the different factors. So simple interest on a declining balance. The amount of money you owe is going to go down, so it should only be paid on the amount that's yet to be repaid, not the full amount. Add-on interest. So this is the one where it's added to the principal, and the total is divided by the number of payments. Anyway, just different ways of calculating it. Adjusted balance. Finance charges are calculated after payments made in the billing cycle have been subtracted, so more like a credit card, the way they do it. And then average daily balance. They look at the average balance, divide it by the number of periods, and but generally are included if you carry a balance. So if you can get that balance down to zero, that's the way you escape paying interest on a credit card. But you have to get it down to zero. You have to pay it off. Cost of open-ended credit. So what we were talking about there with closed-end credit, open-end credit. So again, credit cards. They used to use this 2-cycle method, but it wasn't really fair. It should be the current cycle. So in 2009 that was banned, so we won't spend much time talking about it. Previous balance. So here we go with no credit for payments made during the billing cycle, but they'll look at the previous balance. So inflation is a risk. If you've got money lent out, if a business is loaning somebody credit and somebody's going to pay back this money in the future, and it's with a credit card loan, it's not usually that length of period. But let's say on a home mortgage, if I take out a loan for $100,000 and I'm going to pay it back over the course of 30 years, by the end of 30 years, the buying power of that original $100,000 is greatly devalued, which is taken into account, though, if you look at the loan. If you look at the amount of money you'll pay for a $100,000 loan over 30 years, it's a lot of interest. But inflation works against those folks. And interest paid on consumer debt is not tax deductible, which we mentioned before. So not as good a deal. The credit card companies fought that, but they lost that battle. But it still continues for a home mortgage. So minimum payment, don't get to the point where you're just making the minimum payment, because then interest is rolling up. We got rid of the rule of 78. Again, that was deemed not a fair deal for the consumer, so it was kind of confusing anyway. Credit insurance. This is not necessarily a good deal. You have to die to get it. It protects the lender. So often if you're buying a house or making some purchase, say, oh, we'll give you free life insurance. Well, all it does is pay off that credit card when you die. So it's not so much about protecting you, it's about protecting them. Now, it would be kind of a bad thing to pass on a credit card debt to your kids, but the real reason the credit card companies are into it is because it's a quick and easy way to get that balance settled in case something bad happens to you. Credit card accountability. So we already referenced that in 2009 in terms of them, assessing your average balance over 2 periods. There's also, limits. When they say it's a 1.9 interest rate, it has to stay that way for 6 months. They got to mail statements 21 days before payments due. Anyway, these things are all pretty positive um, for most of us. Other things, all that paperwork, all those things that you have to read in the statement, those are all, you know, not necessarily there because the credit card company wanted to offer that to you. It's because it's because of previous abuse they've been forced to offer that. So also, issuing credit cards to people under 21 without a cosigner, that would be bad. Getting people who don't have the means, getting them in over their head, and it's not a good way to start out your life. So, in terms of managing your debts, the first thing to do is the silent approach does not work. If you are not going to be able to make your payments, don't just keep silent and hope for the best. Generally, creditors will work with you if you let them know ahead of time, because they know if you have a plan, they're much more likely. They just want their money back, and they don't want you to flake out. And especially bankruptcy it's bad for you, it's bad for them, it's just bad for everybody. So believe it or not, you talk to these credit card counselors, and they're actually sort of aligned with the credit card people, but they do to a certain extent actually provide a service to you because they want to get their money back, but to get their money back they've got to keep you viable financially. So anyway, trust them. If I'm saying in most cases you can trust them because they do have some interest in your well-being, just because they want to continue to charge you interest 10, 20 years down the road. Fair credit collection practices. So again, in terms of debt collectors, these folks can be pretty nasty, and if they're working outside the law, which they will do unless you kind of rein them in. So I've never been hounded by these folks, but they can be abusive. Reasons for debt, there's a whole lot of reasons, but there are some things, some sort of medical type situations that might drive you into those situations, and there's nothing we can do about that. Here's a whole lot of reasons that are, not necessarily legitimate things that, I know certain people who get kind of depressed unless they do go shopping, and the rest of it, overindulgence on children, again, especially when there's divorce involved, people try and overcompensate and spend incredible amounts of money that they wouldn't do that on themselves, but with their kids they're trying to push it up. Warning signs of debt problems. So if you're only making the minimum balance, that's a problem. Missing payments, cutting off your utilities. Anyway, depending on overtime to meet routine expenses. But again, it's that brings us back to the start of how this thing all started. The economy is still not screaming along, and so maybe we don't see it here in Alaska as much, but in a lot of places people are hurting. So you're doing the right thing by getting an education, because the statistics on unemployment for college graduates, like I say, are well below average, to the point of it's just transitional. It's just you going from one job to another. Other warning signs, using up your savings, using borrowed money to pay old debts, denied credit card being revoked, so medical and dental visits. That's getting serious. So sources of protection, if you can't get it done, like I say, the credit card companies themselves have these semi-autonomous groups that work with them that will try and offer you some legitimate expense, consumer credit counseling service. So nonprofit, supported by these guys, because it's supported by the industry itself, because they want to, they want to have you a continuing customer. They don't want to have you somebody who goes into bankruptcy and never gets credit again. They've lost a valuable customer. So they will hopefully get you through a temporary problem. And but it's not going to be necessarily rocket science. Education, debt counseling, but that debt consolidation. They can tell you what might be reasonable, what might be accepted, and if you've got all this debt on credit cards, maybe you can put into some other type of loan that's not going to have this open-ended credit nature, because that's what got you in trouble. But you put it on installments, you put it at a lower rate, and maybe you can get out from under it. So that's what they're trying to do for you. Universities, yeah, housing, maybe the organization you work for. So that can help. Financial institutions to a certain extent, but that the consumer credit folks that we're talking about, they want to keep you off of bankruptcy, and you want to keep yourself off of bankruptcy. Bankruptcy is kind of like, it's kind of like suicide. It's a permanent solution to a temporary problem, and 10 years plus, once you declare bankruptcy, that's not easy to overcome. So that's a significant chunk of your life. So if you do get into bankruptcy, and again, I realize that the kid needs an operation, or we got in this horrific automobile accident, and you went from being fine to you got problems, and so if you do get in this bankruptcy situation, there's different kinds of bankruptcy. It's not just one size fits all, but in essence what you're doing is you are turning over your finances to the court, and they're going to tell you what you can spend and what you can't. So first thing you're going to do is you're going to prepare a list of what you got, and that is theirs now, and then they're going to parse that up in terms of the creditors, and in exchange for that you're going to get a better protection. But legal process, yeah, so just what they say there. Assets of the debtor are distributed among the creditors. So, and you don't get to say, well, that's not, no, it's, you declared bankruptcy, you turned yourself over to the court. So women account for 30% of bankruptcies, which says that men obviously have got a higher percentage. 2 million in 2005. So, and it's not really an acceptable tool of credit management, and they've changed things to prevent further abuse in that. So typical things you got Chapter 7 is sort of a general bankruptcy. This is where you give a list to the court. They get rid of most of your debts, but everything you got is up to the discretion of the court whether to sell it or not. So you can keep a few things, but again, it's going to be up to the court, and it's a pretty desperate situation. But under Chapter 7, they'll get rid of a lot of these commercial type loans, and again, there's that hospital and physician bills. So again, that's reflected in higher prices for all those things, because sometimes they lose those loans. But what you won't have discharged is a legal term for it. Money you owe the government, or money you owe the ex-wife, so the ex-spouse, education loans, and debts from willful, malicious acts. So if they feel you're responsible, if you're gaming the system, again, you can still end up with your bankruptcy, but still have those debts. So that's not good. In 2005, they changed it up a bit. Clerk of bankruptcy. Anyway, it's a whole bunch of tactics to try and keep people from entering bankruptcy. Trying to steer you away from it once you make clear your intention to declare bankruptcy. Chapter 13, you may go in there and say, okay, I want Chapter 7. I want to just get rid of all these debts. But if you've got a job, that's not necessarily fair to the creditors. And a less catastrophic thing to you personally would be to have sort of this wage earner plan, they call it a Chapter 13. So voluntary plan, proposed to the court. This is you getting involved, and not so much being told what to do, but just going to the court and saying, look, I need some help. I can't, get through this situation, and if you can, get me some relief, I will, take care of this and sin no more. So you need a regular income, so wage earner plan. $250,000 debt is that's outside the limits. $75,000 in secured debt. So secured debt means it's collateralized, so they can get some of that back. Payments made to a trustee. Trustee was kind of your middleman. And anyway, it'll get you out of that situation. So, chapter 7, chapter 13, you'll need to know just the basic differences between those two. Homework. Okay, so there is no homework for this week. What we're going to do instead is I'm going to give you a break on homework this week, but what I want you to do, and nothing's due out of this assignment, but the end of course project, I want you to, get sort of involved and look at this project. It's the term project. So these dates are wrong. I got this off a different document, so I'll have to fix that up. But you're going to submit it electronically, and basically what you're going to look at is as a college graduate, 5 years into the career, use fictitious data if you like. And, but what you're basically trying to do in this project is look at a point of time in the future and decide, based upon everything you've learned in personal finance and in the book and everything else, is how you're going to arrange your life financially. Again, it would be kind of meaningless to do it now for most people's financial situation, just being in college and not having a huge income. It's you aren't expected to be putting away money for savings when you're taking out student loans at the same time. That's just kind of counterintuitive. But so you would kind of fast forward yourself to your ideal chosen career path, and if you need help with that, there's certain resources like I think it's Glassdoor.com or whatever. You can look and see how much a professional in your chosen field typically makes, and use that as sort of the going in data and sort of set up a budget. Look at also what you're going to do in terms of life insurance and some of your financial goals. I apologize for the formatting on these slides. It didn't really translate from the document to PowerPoint. But if you look on your syllabus, that's where I cut and pasted this from. So in fact, that December 4th may be the correct date because of I did update that. So anyway, things you're thinking about is number one, how are you going to budget things, but also, college saving for your children, if that's going to be in there, retirement, financial future, student loans, how are you going to take care of those? And it will also help you sort of look at the time value of money and make you realize that, say, if I start, if I jump in and I start earning a regular income, say when I'm, before I'm 30, how that's going to translate into, a huge nest egg by the time you're up to retirement age. So as people live longer, all these dates are being advanced out there, but people now have an expectation to probably have a longer period of time in retirement, so it's even more critical that you have more money set aside. So see if there's anything more on that. Social Security, if you're thinking that Social Security is going to be your nest egg that you're going to rely on, you need to look at the numbers and see just how dire that situation is. Or even if you are, eligible, and I wouldn't say lucky to get Social Security, because if you're lucky, you're probably going to be one of the people that's means tested and not getting Social Security at all. Social Security is not like that now, but you can expect, due to the financial situation with Social Security, that it's going to be means tested, and if you've got a regular income or a lot of assets, you're not going to be getting that. So life insurance, we'll talk more about that, but as you get older, you should not really be paying life insurance. You should have a nest egg and be more or less self-insured. So stock market, that'll be kind of eye-watering if you look at that and see how regular investments, how much you can end up with. And the same thing with real estate, if you get some investment property. Look at some of the options in terms of pension plans. If you're in military service, you're going to be entering the market probably when you're, around 40 or so. So that's going to change your whole outlook. Hopefully you'd have a retirement from the military, but that's not probably going to be enough to live on. You're probably going to get a second career. And then also the tax deferred savings, whatever field you're in, 401k, 403b, TSP type stuff. And let's see if there's another. Yep. So anyway, the point with this project is, it's going to be incredibly personal. But again, use fictitious numbers if you want. I won't share this with anybody, and please, if you do put down real numbers, please don't tell me. I mean, I don't want anybody to come back and think I'm got any financial data. That's not the goal. You can use semi bogus numbers and be just fine. And it's all just going to be estimates anyway, because we're talking some period out in the future. But I think through this project, and again, it'll be 4 to 5 pages typed out. I think it'll give you kind of a broad overview of what you should be shooting for. So anyway, that's probably about enough talking for tonight. Any questions? I mean, the good news is that you're actually able to hear me tonight. I will have as the midterm draws closer, I'll make a separate review for that, so don't worry, that'll be a separate presentation on its own. If you do have any questions, send me an email. I've got a bunch of emails to catch up on tonight, but I'll get to that. If I don't hear from anybody else, we'll probably plan on going at 7 o'clock again next Wednesday, and we'll, again, I'm flexible on times, but unless I hear otherwise, I think this is probably better than Tuesday, based upon the few people that are in the chat room. So, sounds good. Thanks.